Ever wondered why some traders consistently beat the market? It's not luck, it's strategy. What if I told you that you could spot the next big market move just by looking at a simple pattern on your screen? Yes, it's possible, and today I'm going to show you exactly how. Stick around as we dive deep into the power of price action and candlesticks. This isn't just trading, it's about mastering the market. Did you know that the key to unlocking the market's next move could lie in the shape of a candle? Not the kind you light up, but the kind that lights up trading charts around the world. Yes, I'm talking about candlestick patterns. Candlestick patterns are the alphabet of the trading language. Just like letters form words, these patterns can tell us vivid stories about the market. Let's start with the basics. Take the doji, for instance. It looks simple, a cross or plus sign, but it tells us there's a tug of war between buyers and sellers, and neither side is winning. This can be a critical signal before a major market shift. Next up, the hammer. When you see this pattern at the end of a downtrend, it's like a battle cry from the bulls, signaling a possible reversal. It's the market's way of saying, it's time to go up. And here's where it gets really interesting, the engulfing pattern. This one literally engulfs the previous candle and can drastically shift the market direction. Bullish or bearish, it screams action. We've only scratched the surface with these basic patterns. Up next, we'll dive into more complex combinations that can help predict the next big market move. You won't want to miss it. Imagine you're a general plotting your next move in a battle. Where would you set up your defenses? In trading, that's exactly what support and resistance levels help us to determine our battle lines. Support levels are like the floor beneath which the market hesitates to fall, while resistance levels are the ceiling above which prices struggle to rise. Understanding these levels helps us predict where the price might pause or reverse, which is crucial for any trading strategy. Here's how we spot the difference between strong and weak levels. A strong support level is one that has repeatedly prevented the price from falling further, showing that the bulls are putting up a solid fight. And on the flip side, a weak resistance level might only show a single touch point. It's like a fence that hasn't been tested much. It might hold, or it might not. Our risk increases around these levels. To mark these levels accurately, we use tools like horizontal lines, trend lines, and moving averages. Let's pull up our charting tool and I'll show you how to do it step by step. First, we identify the peaks and troughs. For support, look for the lows where the price bounces upwards, and for resistance, note the highs from where it falls back. I use horizontal lines to mark these because it clearly shows where the price has reacted in the past. Mastering the art of identifying key levels can dramatically change your trading outcomes. It's all about reading the signs and setting up your strategies accordingly. Stay tuned, because next, we're diving into how to leverage these levels for optimum trading entries and exits. Look at this chart. See how the candlesticks start large and then get progressively smaller as they approach this support level? This shrinkage signals a loss of momentum, a key clue that the downtrend may be running out of steam. Right here, as the candlesticks decrease in size near support, we observe less conviction from sellers. This is often where smart traders start to pay close attention for a potential reversal. And how do we predict these reversals? Candlestick patterns. For instance, a doji or a hammer here can suggest that the tide is about to turn. Let's set up a trade. If we enter right after a reversal signal, like this hammer, our stop loss would be just below the support level, minimizing risk. The take profit, ideally placed at the next significant resistance level, maximizing our potential return. To strengthen our prediction, we also look at volume and other indicators like the RSI or MACD. That's confluence when multiple signs align, increasing our confidence in the trade. Mastering these advanced strategies takes practice, but once you do, you're playing in the big leagues. Keep tuning in, because next time we'll delve into how to adjust these strategies in different market conditions for consistent success. Are you ready to see everything we've talked about in action? Let's dive into our real chart trading example. Watch closely. This is where theory meets practice. Here we have a setup on the Aussie-US dollar pair. Notice the decreasing candlestick sizes as they approach this strong support level. That's our cue. The market is whispering, and we're listening. We've covered a lot today, from the basics of candlestick patterns to advanced trading strategies, identifying key levels, and even walking through live trade examples. It's crucial to grasp how each element plays a part in successful trading. Remember, theory is just the start. The real learning happens when you apply these strategies. I highly recommend practicing with a demo account. It's a safe way to get your feet wet without risking real money. Practice makes perfect, and in trading, it's no different. Test out what you've learned today, see what works for you, and gradually build your confidence.